Thanks for joining us today on Market Call. I'm Marella Fernandez. Nadeem Kassam, our guest on the show, Chief Investment Strategist and Portfolio Manager at Marnoa Private Wealth Counsel. He'll take your question today on North American equities. Here's how to reach us. 1-855-326-6266. And you can email your questions in as well. Market Call at bnnbloomberg.ca. Nadeem, good to see you.
Pleasure to be here. Happy Friday.
Welcome to Market Call.
Thank
what
you.
did you make of that pullback yesterday? Any obvious trigger? It was really ugly.
Obvious, maybe not in the moment, but definitely if we take a step back and look at how markets behave during this period of time from a seasonality point of view, it definitely aligns very consistently with what we've seen over the past 10 years in terms of seasonal weakness during the February-March period of the year.
Why is that?
You know, for one reason or another, folks probably come into the markets having a viewpoint on the outlook and rebalancing portfolios. I think there's one headline or another. It's hard to really pinpoint the reason why folks, came into the markets yesterday and just hit the sell button. But again, it's one thing or another, or a combination of several factors. I think that triggered the recent weakness.
Yeah, I think people just want to get some money so they can get away from the snow.
Possibly.
But that's my thesis. Okay, let's talk about the fact that despite what we're seeing now, you see the year as being positive. Tell me why.
So there's three key underpinnings that I think are quite supportive of our outlook for this year. And again, on my last appearance on BNN, I reiterated these views as well. So we look at the economic backdrop, and so if we look at economic growth, both at the global scale, Canada, US, the trend rate for 2026 into 2027 is relatively healthy, and we're expected to grow at a faster clip than we've seen over the past 3 years for the global economy, and Canada's accelerating at a pace closer to where it's historically trended at. All in all, I think from a macro point of view, employment, inflation, and we had an inflation print south of the border, that really supports the directional tendencies of some of the headwinds that we've seen in past years. So economically, we're seeing fairly good support. Corporate fundamentals, as we've seen come in over the past several weeks in the US, across the Eurozone, Europe, and Japan, have been coming in, believe it or not, well above expectations. And the guidance for the remainder of the year has been very strong too. So there's a consistent tone for the results, and we're seeing a broadening out. So again, that supports our thesis for the outlook for this year.
Okay, let me ask you, how much of that depends on the consumer? We know the American consumers are going to get a tax break this year, and there are other efforts to sort of prop them up and make them confident. What about in Canada?
So that is a one-time payment that's probably going to be provided to the U.S. consumer, call it around April. And so that's going to be a boost. And again, a positive catalyst in addition to past hikes that we've seen, past cuts, interest rate cuts that we saw last year. Mm-hmm. For the Canadian consumer, we're seeing easing. We've had 100 basis points of interest rate easing, and again, a downward momentum in terms of inflation. So those are going to be some of the direct benefits to the Canadian consumer, in addition to the spillover effects of some of the fiscal that's been announced, and it's going to be kind of flowing into the economy.
I was going to say, do you expect that money to get out the door relatively quickly? We know sometimes the process gets bogged down, and then the money that gets announced isn't really out the door for a long time.
Yeah, and I think the key thing to know, monetary or fiscal, monetary policy, those are immediate. If you're on a floating rate mortgage, if you're have some floating lines of credit, you're going to see that immediate change. However, it's imprecise. Fiscal is very precise, but as you mentioned, the process to which fiscal actually makes its way into the real economy is much slower, but it could have a more material impact over a longer period of time. So the defense spending, the housing, the key projects that the federal government has announced and will likely continue to announce, the support on the auto sector, so on and so forth, I think are going to be tailwinds for the economy, the consumer in the years to come.
Okay, let's take a quick break. We'll line up the first phone calls for Nadeem Kassam of Marnoa Private Wealth Counsel. He'll take your questions on North American equities. Here's both the phone number to reach us and the email address. We're back in just a moment. Stay tuned. Welcome back to Market Call. We're going to start with an email from Paul. He says, is this a good time to jump into Northland Power? We turn the question over to Nadeem as we talk about whether or not it is a good time. It's at 1952 today. What are your thoughts on Northland Power?
So I'll give the obvious response. It depends. It depends on your outlook, and it depends on your holding period and your return expectations. So Northland Power has been a lagger within the renewable space, specifically against peers in Canada. It's experienced some challenges in terms of project execution, write-downs, and they've actually recently had to have a dividend cut. So it's a name that looks cheap, very attractive, 4 to 5 times on FFO. So definitely cheap and reflecting a lot of kind of the headwinds or negativity that we've seen in terms of executional risks. And so it definitely warrants a second look. But again, I think for us, it's not one that we prefer in the sector. Got
it. Is there another name you do prefer?
Brookfield Renewables is our preferred choice. And I think there's some fairly good tailwinds that are backing that name. And so we've been active holders of Brookfield and steering clients in that direction.
Okay, let's go to the phone lines. And Sylvain is on the line. He's in Montreal with a question. Hi, Sylvain.
Hi, good afternoon. I would like to know your outlook for TELUS. Thank you very much indeed.
Thank you for the question. Question today, TELUS did a report. They also just changed their CEO. Yeah. But the space is not an easy space these days. What do you think about TELUS?
So if we take a step back and just look at the sector as a whole, there's been some regulatory changes in terms of immigration that has impacted the entire sector. Mm-hmm. We've seen competitive pricing on the ARPU level, which has weighed on a lot of the names within the sector. I think the operational outlook seems reasonable, but again, it's not one that we're overly excited about, just given the existing operating environment and kind of the regulatory hurdles that are ahead for them. Our preferred recommendation is Rogers in the space. We think there's opportunities to monetize their MLS recent investment or acquisition of the remaining stake. And I think from a balance sheet point of view, if we step back and look at all the names within the sector, Rogers looks the most compelling in terms of the outlook from here.
Okay. That was for Sylvain. Let's move on to Ron in Leamington with a question. Hi, Ron.
Hi there. I had a question on Uber Technologies. I bought it a year ago for $75 and saw it go to $100 in November, but now it's down to $70. So just wondering if that's tech volatility or if there's an inherent problem with the stock.
Okay, thank you for the question, Ron. A good question. We don't talk about this one in the tech kind of space. Generally, we talk about the others, but has it been dragged down by something besides concern over tech?
It has not. It hasn't been more operational or executional related headwinds. It's been largely attributed to the tech sell-off or more like the software anti-AI related pressures that we're seeing.
Okay, that being said, would you put new money in today?
I think it looks relatively compelling. Again, I would really think twice about what your outlook is and what you're trying to get from Uber Technology. So it is a growthier stock, and as the caller mentioned, it has been quite volatile just in this short span of time, right? And so it is a great business. The outlook looks fairly reasonable. But again, there will be periods of volatility that are going to present themselves over the next coming years for sure. So as long as you can stomach that, it's definitely a growthier name for one's portfolio.
With the self-driving technology that is being pushed out the door and being tried out more and more across North America, is this model threatened by that, or are they sort of partnering in certain ways to take advantage of that?
Yeah, so definitely partnering. They're definitely leveraging it. This is the same point of view that I like to think about when we're seeing all the selling pressure as it relates to AI pressures or any type of technology stock. I think if you have a one feature product and you're absent-minded to the benefits of AI, you'll probably be under pressure. But similar to Uber, if you're seeing the self-driving technologies and trying to partner with firms to leverage these capabilities and booking a self-driving vehicle, these are ways that companies can actually leverage the capabilities and new developments in technology to really accelerate their businesses. So that's true for Uber, and that's true for even companies within the AI space that are leveraging AI in terms of advancing their benefits of their business.
Yeah, which I think a lot of investors aren't sure about yet, how they're using that. Okay, let's get to Victoria. She is in Edmonton with a question. Hi, Victoria.
Hi there. I have a question regarding Microsoft. Microsoft has been, lagging compared to the Mag 7 names, and it seems like all the software stocks have plummeted, due to the AI revolution. So my question is it a good time to enter and buy Microsoft, or should we, put money in a different name?
Okay,
Thank you so
and sorry,
much.
that was probably Victor, just came up differently on the prompter. So Microsoft also has taken that same beating on software concerns. You have those concerns for Microsoft?
No. So I would say if we look at the 52-week high and we looked at the general software GICs in the U.S. or industry GICs, that sector is in full-on bear market territory, so down more than 25%. As it relates to Microsoft, they just recently reported results, and they were bang on. For example, Azure grew at 39% on a year-over-year basis. They are seeing a tremendous amount of backlog and demand from corporate clients, even ChatGPT related, and even on excluding ChatGPT related demand impulses, the business is seeing very, very strong demand. So again, I think the recent pressure on Microsoft is more emotional and not fundamental. I would use this opportunity and others that present themselves in the coming months to add to the shares.
Okay. Let's get to an email then from Lawrence, who is in Richmond, BC. What are your thoughts on BNS is now a good entry point for a 1 to 2 year hold? Let's look that up and bring the line chart up in just a second and go from there. What are your thoughts, Bank of Nova Scotia?
Yeah, look, I think the banks have had a very, very strong year following the troughs, I would say, sometime in middle of 2024. We've seen, their wealth businesses, capital markets business all improve quite significantly. I think BNS is well positioned. So I think in terms of the outlook, earnings growth is probably set to accelerate at the highest rate versus the other big six or the big six, the broader
Why is that?
group. I think it's a combination of facts. International business, I think it's capital markets, as well as their wealth management operations. Currency translations will be another big tailwind for the business as well. And so I think from a valuation point of view, as well as the earnings outlook, it definitely looks compelling within the Canadian bank space. Again, good name to look on adding on weakness.
Just out of curiosity, they've done a lot of layoffs recently.
Yeah.
And I'm wondering, is that an advantage to them from AI that they've been able to downsize, or is that just part of their sort of retooling process, the plan that's in place now?
So we've seen that, that's not an isolated incident with just BNS. We've seen that across the board with companies, including the Canadian banks as a whole. I think a key factor here is just right-sizing the business for the operating environment, right? And so they have a lot of fat to trim, as do some of the other banks. And so this is an opportunity to realign and right-size for the business environment.
Got it. Okay, let's take a quick break. Nadeem Kassam is with us today of Marnoa Private Wealth Counsel. He'll take your questions on North American equities. Here's the number to reach us. Back in just a moment. Welcome back to Market Call. Let's go to an email. This is from Mary. She says, would appreciate an analysis of open text. Why has the stock performance been so poor in the last 5 years? And what is the outlook? Is it time to sell open text again on the same concerns I think have really dropped out? But they've also changed their CEO. So there's a lot of pressure within that company.
Yeah, so I think there are a few factors that have been weighing on the stock. One, to state the obvious, has been AI. And so we've seen the AI headwinds begin actually in 2023 with ChatGPT's first iteration. We saw DeepSeek last year, and then the continuation of the pressures throughout much of 2025 and now into 26. So that's been an ongoing challenge. I think the enterprise software business has been pretty challenging for OpenText. They have been doing quite a bit of M&A, and that's been great, but deleveraging has been the headwind for the business. Organic growth has been slow, and so getting businesses on the enterprise cloud and really supporting them on those initiatives hasn't been as effective as one would like. And then again, we've had a bit of a management shuffle with the CFO, CEO. So I think if I step back, we're seeing similar pressures, baby with the bathwater, if you will, across the Canadian software space as well as the U.S. And so if I look at where I see the best businesses, best execution track record, a management team that I trust, and even SaaS solutions, if you will, that are industry leading. Again, I wouldn't necessarily point to OpenText as my preferred choice.
Okay, so would you sell at the point where it is now? Is there a recovery you think is possible to hang on for?
There's definitely some recovery. Again, it really depends on the positioning right now. I think there have been a lot of names that have sold off quite comparably to the levels that we've seen for OpenText, and so there might be there might be a thesis here to sell low and buy low as well. And so it really depends if the caller wants to hold for a bounce. That's great. Otherwise, I think there's really good opportunities out in the market right now to deploy capital.
Got it. Okay, let's go to our next caller then. Frida is on the line. She's in Chilliwack, BC, with a question. Hi, Frida.
Hi there. I'm interested in your outlook for Shopify, please. Thank you.
Okay, thank you for the question. Shopify is very volatile.
Yes.
Reported earnings did really well, still tanking.
Yeah.
And I know the valuation's an issue. So what do you do with Shopify?
Yeah, so if you look at the Canadian tech space, Shopify was a strong performer last year, not trading cheap. So even though we've seen some pressure in the shares, the valuation thesis is not there today. But I think if you take a step back and you look at the type of exposure you're getting, this is probably for investors that are looking for AI exposure. This is probably your primary bet in terms of a Canadian tech name. Definitely a good quality, again, disrupting the retail sector, and one that we definitely like. Again, we expect a little bit more volatility and some further downside in the shares before we get really excited about it.
Oh, you do? Okay. Yeah. And is it a long-term hold once you dip in?
For sure, yeah.
Got it. Okay, let's go to the next caller. Charlie is on the line. He is in Montreal. Hi, Charlie.
Hi, thank you for taking my call. I'm calling about Amazon today. I took a small position. I'm slightly in the red now. Do you think this is a good, with the recent pullback, is it a good time to average down, or do you think there's more downside coming up? Thank you.
Okay, thank you for the question. Let's talk about Amazon's business model. Also, one of the Mag 7 that's been dragged down. But do you like it long term?
I love it long term. It's a core holding for us. We own it for our clients. It's a name that I've been a holder of personally over the past 10 plus years. I think it's probably one of your best names within the hyperscaler space, right? So if you are of the view that AI is going to disrupt every single business out there, again, one extreme, you can't do it without having that ecosystem to support. So, their cloud, AWS, is a key place where, companies and even developers are building their models, testing their models, and being able to, again, generate businesses from these inferences, right? And so, with the exception of Google and Microsoft, there aren't other major, and Meta, there aren't other hyperscalers in North America that investors can have exposure to. If we step back and look at the core retail business, more than 50% of online retail sales are done on Amazon. Shopify.com, right? And so it's a core business. They continue to realize strong benefits across their core business, and AWS is great optionality in terms of the AI outlook.
Okay, we'll get you an email in a moment. I just want to say in the next block, we'll talk about the Capex spending,
Yes.
right, which has a lot of investors concerned and
Yes.
looking for some return on that investment. We'll get to that in a moment. Let's get to the email from Sam. He says, I'd like to know your view on Magna International. I have some stocks and I'm making a profit and some are even at today's price. Should I keep it or sell it at this time? Magna actually reporting earnings and did have a situation where they had to pay out, I guess, a customer and $1 million loss, net loss from that.
So I think today was a blowout quarter. Definitely surprising consensus, and that's evident in the performance of the stock this morning. I think there are definite headwinds as USMCA or CUSMA gets negotiated this year. But again, I think the underlying trends, if you're of the view that these auto supply chains, irrespective of what the U.S. president thinks, they're not portable and they're not easily replaceable. And so this is not going to change the supply chains, and we're of that view, and this is not going to happen overnight. And Magna being one of the largest, if not the largest, auto parts manufacturer and supplier, I think it's still a great name to own here at these levels and look for weakness to add over the coming years.
All right, let's take another quick break. Nadeem does not have past picks, so we could open the phone lines when we come back as well. Stay tuned. Welcome back. Nadeem doesn't have new picks. He's new to Market Call, so we are going to have a bit of a conversation right now. I'm going to go back to your phone calls in a moment. I want to talk to you about Capex spending because hundreds of billions of dollars are getting pushed out the door, and investors are really concerned about whether it's an overspend and whether they're going to get return on investment from all of those millions and billions of dollars. Yeah. So what is your take on whether there is overspend happening here?
I think it's hard to tell if there's overspend. What I can say when I look at, let's say, the Mag 7 or even like the hyperscalers and specifically even in Microsoft, which is expected to spend about $130 billion over the next 12 months, I look back at their capital allocation decisions in the past and what types of returns they've generated versus the actual cost of capital. All the Mag 7s, for the most part, majority of them have generated upwards of 20 to 30% returns on invested capital. And so for me, it's hard to tell if there's excess here. What I can say is that history does help with guiding our views in terms of how effective management has been in terms of deploying capital and realizing the benefits of those investments. If I look at some of the operating numbers that I looked at for some of the MAGs that have reported, again, they're seeing strong underlying trends. They're seeing strong corporate demands, strong business fundamentals that are supporting the build out and, again, the investment justification, right? And so I think it's early days right now. I think the general consensus is a bit of a sticker shock in just the sheer amount that is being committed to this build out. But again, I think when we take a step back and look at why we are investors in some of the Mag 7s, it's because of their disciplined and historical track record at deploying capital. So do you think investors are being too demanding by saying, show me the money right now? I think it's still early stages, right? There's no AI infrastructure, right? And so, and whatever is there is being used up, right, at a very accelerated pace, right? So chips, if you listen to NVIDIA's conference calls and recent discussions, they can't keep up with demand, right? And that's the consensus kind of globally, right? And so the demand is high, and therefore that's being driven by a lot of this consumer and real-time usage of AI across the global ecosystem, right? And so there is strong demand, and there is, in my view, strong visibility to the monetization efforts. It's not going to happen overnight, but when you go look at, kind of go into the details, of what they're seeing, recent data points. Again, for Microsoft, you look at Copilot, they are seeing strong demand, believe it or not, right? So these are helpful tidbits to support our perspective in terms of their capital deployments.
We talked about volatility at the start of the show, much of it coming from Washington and decisions that sort of change daily and hourly. I'm wondering whether you're seeing anything from that end that could derail the markets this year. Like if Kuzma gets blown up, right?
Yeah, and again, I think there's all of these blue sky or extreme events that could happen, right? I think the way we look at the risks in the market is looking at them from a probability point of view. So if they have a probability of over 50% of occurring, then for sure we're going to factor that into our assessment of our equity allocations, our fixed income, FX exposures, et cetera, et cetera. The fact that Kuzma can blow up, I think, would be detrimental, probably even more so to the U.S. than it will definitely be meaningfully negative for Canada, but it's not something that can happen. I think it's definitely in the range of extreme scenarios, but it's not in our base case. I think there's going to be some puts and takes, as we saw, in the first iteration.
Yep.
Yeah, and we're seeing this overnight too with agreements with Taiwan. We're seeing even the can kicked with China. The agreements that have been made, again, have been way more digestible than Liberation Day, initial sticker shock in terms of the tariffs, right? So again, when we look at the U.S. administration, I think the U.S. president is shooting from the hips and kind of testing the waters in terms of who will flinch first. But I'm pretty confident in that there's probably going to be a fairly reasonable outcome from Kuzma negotiation. There's probably going to be some puts and takes, but I think in the end, closure on this deal is going to be probably beneficial, even if there's going to be some headwinds to certain sectors. It's going to be at least something that investors can look past, companies can look past, and then start deploying capital, right?
Okay.
So.
Except that he changes his mind all the time.
I know.
He might time the deal today and then decide tomorrow he doesn't like it. So I'm glad you have more confidence in that than I do. We're going to take a quick break. We'll be back in just a moment. Stay tuned. Welcome back. We will go to our next caller right now. Aline is on the line. She's in Montreal today. Hi, Aline.
Hey there. Hi. I'd like your opinion on Royal Bank stocks.
Okay. Thank you for the question. We talked Nova Scotia earlier today. Royal Bank always has done very well. It's at 230. What are your thoughts?
We definitely like Royal Bank. It's a core holding for us. It's again with the broader bank group. Royal Bank has outperformed, and it's a phenomenal name in terms of operational performance across all their various business segments, capital markets, wealth management, and so on. Again, that's reflected in the price and also the multiple. It's not cheap here, but definitely a strong core holding. It's a good name to possibly buy on weakness, but again, a name that we're very positive on over the long term. So buy on weakness, but otherwise.
How much weakness does the stock see, though?
Yeah, we haven't seen it since 2024. I would say that was probably the trough where there were headwinds as it related to interest rates, housing. Net interest margins were pretty tight, and loan loss provisions were inching up from very, very low levels. I think the key thing when we look at the Canadian banks, it's been a good operating environment, but again, if we're optimistic in terms of some of these blue sky scenarios, interest rates have been cut over the past year. That's going to definitely provide some support to the consumer. We're seeing downward pressure on inflation. If we get some resolution, because again, believe it or not, Kuzma has been a headwind for a lot of companies and even consumers. So if we get some resolution there, I think the appetite to spend, the uncertainty will definitely improve. So again, will we see a little bit of an improvement in terms of housing activity? Will we see a little bit more of a continuation of the retail strength or consumer strength that we've seen? Retail sales have been very strong. Again, those are going to be very strong from a follow-through effect to the Canadian banks and even the consumer. And in particular, if you think about the The loan book, again, housing has been something that's been under pressure. And the lending books have been challenged. So again, these are elements that if the consumer is in a bit of a better position, that should act as a tailwind for earnings for Royal Bank and the broader Canadian bank sector.
Okay. All right, let's go to Frank. Frank's in Toronto. He's got a question. Hi, Frank.
Hi, Marella. Hi, Nadeem. My question is regarding Restaurant Brands International. They came out with their results yesterday. They got punished. I just wanted Nadeem's opinion on this sector and in this company as a whole in the next 3 to 5 years.
Okay.
What is his thoughts on that? Thank you very much.
Thank you. Wow, look at that chart. That is a lot of up and down. They're hit by inflation. That's part of the problem for them. Input for coffee, beef prices went up 20%. They went Burger King and Tim Hortons. Tell me sector, first of all, what you think. And then if you want to talk about Restaurant Brands specifically, that'd be great.
Yeah, so if you look at the consumer space, there's been some winners. There's been a lot of losers, so discretionary space in particular, right? And so, that's reflective of just the consumer environment, but as you said, also on the input cost perspective, right? And so do we see some line of sight in terms of the next 3 to 5 years? I think definitely if that's your holding period, I think there's visibility to buy this when it's out of favor. So again, I think that is probably my perspective in terms of how I would look at the name today. There's pressures, there's reasons not to own it, but again, some of these are temporary. They will subside. Tim Hortons is a strong Canadian brand. Burger King is still a strong North American brand. And
it does in the U.S. It does very well.
Exactly, it does very well. And again, I think this really hinges on the consumer. Do I think the consumer is going to be in the same position as it is today, given the uncertainties that are kind of pressuring them, housing, inflation that has over the past several years, and just the uncertainty related to trade and really the job market? I'm hoping not. And so if I'm right on that, plus the kind of operating environment from a commodity point of view, and operational execution, I think this could be a reasonable time to buy it when it's been sideways for several years.
Got it. Okay, let's go to Amin in Ottawa with a question. Hi, Amin.
Hi.
Go ahead.
My question for the guest is about smart centers. I own a lot of REITs, and one of them is also Granite. So I want to have his view on the
space. Okay, let's take a look at so smart centers, of course, shopping, retail kind of space. Where are you on REITs these days?
So again, this has been another challenging sector for obvious reasons. I would say trade is one, but I would say the bigger headline is interest rates. Shopping centers, believe it or not, is a pretty compelling area in today's market relative. If we look at kind of some of the winners last year, it was actually seniors housing. Our pick in the retail space is Primaris. We see there's a pretty good opportunity in terms of kind of monetizing their real estate portfolio, really attractive valuations. Smart centers in the same wheelhouse, if you will, compelling, very strong assets. Anchor tenant is Walmart. So again, it's a good name. I'm not really worried about the dividend here. That's been a concern. If we look elsewhere in the space, allied office property, if you will, the office sector, there's been pressures there. So retail is holding up fairly well, all things equal. I think the interest rate environment has provided some tailwinds that I think we're going to start seeing the benefit of in 2026 and as we look forward beyond that. So again, I think retail, I think the REITs in general this year have gotten off to a better start than they had, in terms of their performance.
And Primaris had the Hudson's Bay drag last year, right? Which I guess is now recovering from.
Exactly. So they get to, put that block of square footage on the market and kind of get a new tenant in there or optimize that space, right? And so Primaris is great. Is a good name. I think our kind of horse in the race as it relates to the retail REIT space. Smart centers is not too far behind.
Okay, let's take another quick break. Getting to more of your phone calls with Nadeem Kassam when we come back. Stay tuned. Welcome back. Let's go to an email from Kay on Cameco. She says they reported earnings of $199 million, but their PE is 131.25 and stock down today. Would it be a good stock to buy and hold in my RSP, or is it still too high? Cameco, uranium, people looking at nuclear build out. Do you like it?
So this is a theme that has caught some momentum with this nuclear reinvigoration, if you will, right? And we're seeing that globally. And it was, a key catalyst was the U.S. administration. And if we look at the underlying thesis behind why nuclear is coming back into fashion or back in vogue, it is driven primarily on, not primarily, but a key driver of that is the AI demand.
The AI build-out, yes.
Exactly, right? And if we think about stability in terms of the energy grid, if we think about the most kind of bang for the buck in terms of energy cost, nuclear by far is probably the most cost effective. However, building out nuclear facilities, nuclear reactors are not an easy thing, and they don't occur over a very short period of time. There's also been significant developments in small modular reactors, and we've seen...
And that there's a movement for that.
There is a movement, but again, covering several, or SNC or Atkinson once upon a time as a equity analyst, I'm quite familiar with the regulatory hurdles and the steps involved in bringing a new nuclear reactor to market. So I think there are strong underlying trends. There were a pretty big wave of decommissioning in the U.S. Actually, globally, several years ago, the largest decommissioning was occurring in the U.S., and so that's a big flip on the other side in terms of the direction of that the U.S. is going in terms of their posture related to nuclear, right? And so I think Cameco is a great name longer term. I think there's underlying fundamental demand for uranium, and so that's one way to play that. Here in Canada, Atkins Realis is another way to play it indirectly.
Is it more engineering?
It's more engineering, but again, they have a strong competitive business within the nuclear space, and they essentially own the CANDU technology. Those are what essentially all the Canadian nuclear reactors are built on, and we're probably going to get one more maybe in the next decade. But again, their expertise in building out nuclear reactors, maintaining them, and so on and so forth, even on the decommissioning side, they stand to benefit. So there's two ways to play it.
Right.
Play the commodity angle. I think a safer way is Atkins Realis in
on that
Canada.
side.
Yeah.
Got it. Okay, let's get to an email from Franny. Can you give me your thoughts on Allied Property REIT, which I think you referred to at one point.
Yes, I did.
But let's get back to REIT. What do you think of Allied?
Yeah, office has been a really tough segment within the Canadian REIT space. And so, it's cheap, attractive. They have a fairly good class one real estate here in Toronto and Montreal. But again, vacancy levels are pretty challenged at this point. And, they cut their dividends. So if you're trying to be patient with the name, but there's risk to the balance sheet, the leverage, and as a result, forcing management or the board to cut the dividend by 60%. Again, you're not really getting paid to wait. You're actually getting paid less to wait. So it's not a name that we like, at least not in the first half. We want to see material changes in the business. And so what that looks like is monetization of certain assets and divestitures across their portfolio, especially of some of the non-core and even some of the multi-asset residential properties that they own. And so until we start seeing that and some visibility going forward, and, then maybe we will get on board. But right now, office as a segment within the real estate space is not something that we're really jumping over.
Away from.
Yeah, we're staying away from. Yeah, there's better alternatives, I would say. So Primaris is probably our horse in the race, and so.
Okay, let's take another quick break. Then we have new picks from Nadeem. When we come back, stay tuned for that. Join us on Tuesday for Market Call. Rebecca Telscher will be on the show. She's portfolio manager at New Haven Asset Management. She'll take your questions on Canadian dividend stocks. That is on Tuesday next week. And time to share some top picks from Nadeem. We're going to start with Brookfield Core, BN on the TSX. This is the parent company of the Brookfields. Why do you like the parent company over some of the others?
Yeah, so, my perspective on Brookfield, the parent is just it gives broad-based exposure to a number of different businesses. So for those unfamiliar with Brookfield, it's an alternative asset manager, 3 key segments, asset management, wealth solutions, and their operating businesses. And so what we're all, or many of us are familiar with is the operating businesses, which includes infrastructure exposure, PE, private equity, for those unfamiliar with that term, and renewable, as well as property. And so I think what Brookfield gives is diversified exposure to a bunch of these different segments. And so they reported last night, blew out the expectations as it related to distributable earnings. They bought back $1 billion of stock. I think they're in a really unique point in the current environment, in that we're seeing some pretty significant and sizable secular themes that they're able to take advantage of. So this includes electrification, AI, as well as what's called energy and the needs. And so I think for them, they're an excellent capital deployer, and they've been able to be quite opportunistic and strategic in terms of how they put capital to work, and more importantly, when they put capital to work. Okay. And so in an environment where we're expected to see quite a bit of volatility and uncertainty around the inflation picture, their exposure to real assets is a great way to hedge one's exposure within their portfolio. So we like them because it gives you this broad-based global exposure to real assets from a strong capital allocator. Okay, let's get your next pick. WSP Global, WSP on the TSX. They are also sort of engineering. What do you like about WSP? WSP Global is again a core holding for us. It's been a name that I've held for many years. I think for me, it's their executional track record. So since their IPO in, I believe, in 1996, they've made upwards of 130 deals across 4 segments of their business. So environmental, transportation, environment, as well as energy segments. And so they've been able to make these acquisitions as well as grow organically, collectively at a 20% CAGR in terms of their revenue and their EBITDA at a comparable rate. So they've been able to really deliver on both the acquisitive side as well as the organic side. And again, taking a step back in terms of where we are in terms of the global picture, as a direct result or indirect result of what we've seen stateside in terms of the global liberation tariff trade war that was announced last year, countries are looking internally. They're looking to spend on core infrastructure across all of these major segments. The build-out's happening everywhere. Exactly. And so this is where WSP shines, right? And so they provide those capabilities to all corporate and government entities around the world. Okay, we've got about a minute left, and I want to get to your third pick, which is Canadian Pacific, a well-known rail line. What do you like about it? Yeah, so short and sweet. I think they have an unrivaled network, and I think I probably would have said that several years ago, but with the KSU merger or acquisition, they now only have they have the only network that spans Canada, the U.S., and to Mexico. We're still in the early stages of this, realizing the synergies on the cost side, but we haven't even seen the revenue synergies materialize yet. And you think that'll be a big boost? That's going to be material, but again, if you look at the business as a whole, it's really de-risked itself in terms of its global, its markets that it competes in terms of also the underlying sectors that it is operating in now. So again, a strong business, strong executional track record, and we think it's well positioned. Got it. Nadeem, thanks for coming in. Appreciate your time. Good to have you on Market Call. And thank you, everyone, for joining us today on Market Call. We'll see you back here on Tuesday.